Most founders walk into a VC meeting without understanding how the person across the table actually makes money. That is not a small gap in knowledge. It changes everything about what you say, what you offer, and what you should never agree to. This video fixes that. By the end of the next 15 minutes, you will understand venture capital the way investors understand it, not the way startup media tells you to understand it. Let's start at the beginning. Venture capital is not a loan. It is not a grant. It is not a reward for having a good idea. It is a financial instrument built around one specific goal: finding a company that returns the entire fund. That last sentence matters more than anything else in this video. Write it down if you need to. A VC fund is not trying to make a little money on a lot of companies. It is trying to make a lot of money on one or two companies while accepting that most of the others will fail. The math requires it. The structure demands it. And if you do not understand this going in, you will misread every signal you get from every investor you ever pitch. So how does the fund actually get built? Who puts the money in and who decides where it goes? Every venture capital fund has two groups of people. The first group is called limited partners, LPs for short. These are the people and institutions who provide the actual capital. Pension funds, university endowments, family offices, sovereign wealth funds, high net worth individuals. They hand over their money to be invested, they expect a return, and they have almost no say in the day-to-day decisions. They are the invisible owners of the capital. The second group is called general partners, GPS. These are the people you actually meet. The partners at the VC firm, the ones who sit across the table at a pitch meeting. They manage the fund, source the deals, make the investment decisions, and take the calls when your company is struggling at 2 a.m. Here is the structure that most founders miss. The GPs raise money from the LPs, pool it into a fund with a fixed size, let's say $100 million, and then have a fixed window, typically 10 years, to invest it, grow it, and return it. The fund has a lifespan. It has a deadline. Every decision the GP makes is shaped by that clock running in the background. GPs are compensated in two ways. First, a management fee, typically 2% of the fund annually, which covers salaries and operations. Second, carried interest, known as carry, which is typically 20% of the profits above the initial investment. That 20% is where GPs actually get wealthy, and it only activates if the fund returns more than what the LPs put in. This is why VCs behave the way they do. They are not being cautious with your company, they are protecting their carry. Here is the number that changes the conversation. Andreessen Horowitz, one of the most well-known venture capital firms in the world, receives around 3,000 inbound pitches every year. They invest in approximately 20. That is a funding rate of 0.7%. According to research across all U.S. startups, only 0.05% of all companies that incorporate ever raise venture capital at all. Read that again, 0.05%. The VC world is not a meritocracy where good ideas rise to the top. It is a power law environment where a tiny number of companies attract the overwhelming majority of capital, attention, and follow-on investment. That does not mean you should not seek VC funding. It means you should know what game you are playing before you sit down at the table. What actually gets a company funded? It is almost never the idea alone. VCs evaluate deals on 4 things, not 20, not 10. 4. The first is team, not your idea. You. Who is building this? Have you done hard things before? Do you understand the problem at a level that suggests you will figure out what you do not know yet? The team is evaluated first because ideas change, markets shift, the product pivots. The one thing that stays constant across all of that turbulence is the quality of the people running the company. This is why investors spend as much time researching the founders before a meeting as they spend in the meeting itself. They are looking for evidence of resilience, not confidence. Anyone can be confident in a pitch room. Resilience shows up in what you did when things went wrong. The second is market size. VCs need to invest in markets large enough that even a small share represents a significant return. If the total addressable market for your product is $200 million, a VC cannot get excited. Even if you capture 20% of it, that is only $40 million, which does not move the needle on a $100 million fund. They need a billion-dollar market minimum, preferably larger. The third is traction, not projections, not plans, evidence, revenue, users, retention rates, partnerships. Something that proves the market wants what you are building before you are asking someone else to fund the next stage of building it. Traction is the most powerful word in a pitch meeting because it replaces speculation with proof. Even small numbers matter if they are moving in the right direction. 10 customers paying consistently tells a VC more than a slide showing 10,000 potential customers who have not been asked yet. The fourth is timing. Why now? The best ideas are not just good ideas, they are good ideas at the exact right moment. Airbnb pitched when trust in strangers online was becoming normalized. Zoom pitched when remote work was beginning to scale. Being early is almost the same as being wrong in venture capital. The timing question is often what separates a funded company from a great idea that never went anywhere. You get a term sheet. Your instinct is to celebrate. Hold on. A term sheet is not a check. It is a document that sets the terms under which the investor will write the check. And inside that document are clauses that will shape your company for years. Most founders read the valuation figure and stop there. That is exactly what investors are counting on. 3 terms matter more than the headline number. The first is the valuation cap. This is the maximum valuation at which your current investors can convert their investment into equity in a future round. A low cap sounds fine today, until your company grows and you realize you locked in a price that gives early investors far more equity than you intended. The second is pro rata rights. This gives existing investors the right to participate in future funding rounds to maintain their ownership percentage. It sounds protective. In practice, it means your existing investors can crowd out new investors in later rounds, which can complicate your ability to bring in the strategic partners you actually want. The third is liquidation preference. This determines who gets paid first if the company is sold. A 1x liquidation preference, which is standard, means investors get their money back before founders see a dollar. A 2x preference means they get double their investment back first. In any acquisition below a certain threshold, founders can walk away with almost nothing even when the company technically sold. According to PitchBook and the National Venture Capital Association, the median Series A deal in 2025 was $3.6 million. The median Series B was $13.7 million. Those numbers sound significant. But after liquidation preferences, pro rata rights, and the dilution that compounds across multiple rounds, the founder's actual return at exit can look very different from what the headline valuation implied. Understand every line before you sign anything. Dilution is permanent. You do not get those shares back. You start with 100% of your company. You raise a seed round and give away 15%. You are now at 85%. You raise a Series A and give away 25% of the post-money company. You are now below 65%. You raise a Series B. You issue options to a new engineering team. You give a board seat to a new investor. By the time a typical venture-backed startup reaches Series C, the original founders often own somewhere between 15 and 30% of the company they built. This is not a scandal. It is the deal. Dilution in exchange for capital that funds growth that makes the remaining percentage worth far more in absolute terms. That is the bet. But it only works if the exit is large enough, and Harvard Business School research found that 75% of venture-backed companies never return cash to their investors at all. That number deserves a moment. 3 out of every 4 companies that successfully raised venture capital, companies that passed the pitch, survived due diligence, and received a term sheet, still never produced a return for the people who backed them. The bar for getting funded is high, the bar for producing a return is higher. Both of those facts need to live in your head at the same time, which is why the number that should drive every funding decision is not how much capital you can raise. It is how much capital you actually need to reach the next milestone that de-risks the company enough to raise the next round on better terms. This is the part that explains everything about how VCs behave in a meeting and why their incentives are almost never perfectly aligned with yours. A VC fund needs to return its entire capital to LPs, plus a meaningful profit to be considered successful. On a $100 million fund, that means returning at least $200 to $300 million across the whole portfolio. Here is the problem. Data from Andreessen Horowitz shows that of the roughly 200 companies funded by top VCs in any given year, Approximately 15 of them generate nearly all of the economic return. The rest either fail, return less than invested, or produce modest outcomes that do not move the fund's numbers. This means every investment a VC makes has to be evaluated against one question. Could this company be one of the 15? Not could this be a $20 million exit? Not could this be a solid $100 million business? Could this be a $1 billion outcome? If the honest answer is no, they will pass. Not because your company is not good, because it does not fit the return profile that makes their fund work. This is why VCs pass on companies that are well-run, profitable, and growing steadily. Steady is not the game. The game is exponential. Think about what that means in practice. A VC who invests in your company at a $10 million valuation needs you to reach a $100 million outcome just to produce a reasonable return for their fund. At a $20 million valuation, the number you need to reach doubles. The multiple required is fixed. The only variable is how big you can actually get. This is why VCs push for growth at a pace that sometimes feels disconnected from what the business actually needs. Understanding that does not make the rejection sting less, but it does mean you can stop taking it personally and start evaluating whether VC is actually the right funding model for the company you are trying to build. VCs make money in one of two ways: an acquisition or an IPO. There is no third option that makes the fund math work. An acquisition is when another company buys yours. The acquirer pays a price. That money flows through the cap table based on ownership percentages and liquidation preferences, and investors and founders receive their share. The VC fund books the return and uses it to demonstrate performance when they go out to raise their next fund. An IPO, an initial public offering, is when the company lists its shares on a public stock exchange. Investors can then sell their shares on the open market over time. IPOs take longer, require more infrastructure, and are subject to market conditions the company cannot control. But for the largest outcomes, they are typically the most valuable exit path. Most founders think about exit as something that happens at the end. VCs think about exit from the beginning. Before a term sheet is signed, the best investors have already mapped the likely acquirers, estimated the valuation range at exit, and modeled whether the outcome justifies the investment. You should be doing the same thinking before you take their money. What most founders do not account for is the fund timeline. A VC fund has a 10-year lifespan. If you raise from a fund that is already 5 years into its cycle, your investor has 5 years left to engineer an exit before they have to wind down the fund and explain the unrealized positions to their LPs. That pressure is real. It will shape how your board behaves and what kind of outcomes they push for as the clock runs down. Know which year of the fund you are raising from. It tells you more about what your investors want than anything in the term sheet. Here is what to take from this. Venture capital is a specific tool built for a specific purpose with a specific set of incentives that shape every interaction you will ever have with an investor. It is not inherently good or bad. It is a structure, and like any structure, it rewards the people who understand how it works. If you are building a company with billion-dollar market potential, a founding team with deep domain expertise, and early evidence that the market wants what you are making, VC can accelerate everything. If you are building a strong, profitable business that does not fit the power law return profile, there are other tools. Revenue-based financing, angel investment, strategic partnerships, debt. The answer is not always venture capital, but the answer is never. Sign the term sheet without reading it. Understand the fund structure. Know what you are giving up. Model your dilution before you negotiate your valuation, and never walk into a pitch meeting without knowing how the person across the table actually makes their money. That is how venture capital actually works.